Modern consumer banking has mastered convenience. Within minutes, you can open an app, spin up a digital debit card, link it to Apple Pay, and send instant transfers to a friend across the country. But the moment you deposit your money, the bank seals it away. That frictionless experience requires a massive, invisible compromise. By depositing your paycheck into these apps, you agree to a custody-first model. You hand over legal ownership of your capital to an institution, trusting them to hold it safely and grant you access only when you ask for it. When that trusted counterparty takes on too much risk, your access vanishes. In 2022, centralized platforms holding customer assets collapsed entirely, freezing billions in user funds overnight and proving the inherent risk of the custodial model. The current financial system presents a rigid ultimatum. You trade financial sovereignty in exchange for the ability to buy a cup of coffee. Self-custodial crypto wallets offer a different path. They provide absolute, borderless ownership of assets like Bitcoin. No bank can freeze these funds, and no counterparty can leverage them for risky bets. Yet this ownership comes with severe friction. Users are forced to manage complex 12-word seed phrases to secure their accounts, and using that digital cash for everyday spending remains a technical hurdle for the average earner. Historically, the financial industry has treated these two systems, legacy banks and crypto wallets, as parallel, incompatible tracks. A two-stage money account eliminates the forced choice between institutional convenience and personal ownership. A modern financial product must provide both the permissionless global saving mechanics of crypto and the frictionless local spending of fiat currency. Nuri functions as a money browser, a software interface designed for direct interaction with the blockchain, rather than a traditional bank holding deposits. To remove the friction of traditional crypto onboarding, Nuri replaces vulnerable seed phrases with biometric, user-owned passkeys. This architecture ensures that only the account owner can sign transactions and access their Bitcoin or stablecoin reserves using the hardware security already built into their smartphone. This delivers a core experience of absolute self-custody and global digital cash without the technical intimidation of a legacy Web3 wallet. For real-world utility, Nuri utilizes an interchangeable partner strategy. Instead of building expensive proprietary banking networks, the software plugs directly into existing regulated local rails. When you initiate a purchase, your Bitcoin is instantly swapped into a stablecoin via network solvers, which scan for the best exchange rate across the chain. This newly converted stablecoin settles on an EVM smart account to instantly fund a localized payment partner. While the backend handles multiple blockchain transactions and currency swaps in milliseconds, the end user simply swipes a debit card at a standard merchant terminal. Relying on third-party APIs allows Nuri to flip a switch to support local payout rails anywhere in the world, bypassing the need for physical banking infrastructure. This enables rapid expansion into emerging markets, allowing for seamless transfers to local networks like M-Pesa in Kenya or Pix in Brazil. This chart shows the variable fees across dozens of global payout corridors. Nuri generates revenue through standard 1.5 to 2% remittance margins and front-end fees every time this money moves. This model builds a globally scalable remittance business without the company ever taking legal custody of user capital. Nuri operates with significant structural leverage. By utilizing public blockchain infrastructure and licensed partner rails, the company avoids lending risks, proprietary mainframe costs, and the heavy compliance headcount of a neobank. Traditional neobanks require massive, continuous cash burn to sustain their regulated infrastructure. This capital-light approach reduces operational overhead, providing a larger buffer against the market volatility that typically liquidates high-burn custodial platforms. This slide highlights a strategic €200,000 investment used to acquire a brand that previously raised €42 million. Nuri inherited the domain and nearly 9,000 existing backlinks following the original company's closure. This SEO footprint and 500,000 legacy users allow Nuri to bypass the crypto-native niche and immediately market a self-custodial product to mainstream earners. The future of retail finance relies on decentralized interfaces that grant users direct control of their assets worldwide, while maintaining the utility of a standard local debit card.